I think if somebody doesn't know what's going on in Washington, what's going on with the national economy, they've been like, what is it, Rip Van Winkle? They've been asleep for months now. But here in Los Angeles, I think it's very important for us to understand how this affects us as a city and as a community. But today I'm going to be asking some individuals questions about how did we get here, their best understanding of how the country got here and what it means for Los Angeles, and basically what is going on in the country, what is going on when we read things, and let's talk in plain English about what that means to Angelenos and for the rest of the country. In addition to this, I think it's important for us to understand whether or not this happened overnight. Because in the first few weeks of this discussion over the last few weeks, it seemed as though nobody wanted to talk about how we got here. They just started talking about how we possibly could affect the situation and get out of it. Speaking of that, I think it's important for us to understand how we got here and whether or not there was relaxed oversight when it comes to the industries that people are talking about today. In addition to that, I think it's important for us to understand what does it mean for the federal government to have a $700 billion bailout, and in addition to that, should the chairman, federal chairman, have the ability to have an open checkbook? Because when he has only submitted a 3-page document about this new world order and responsibility on his part, I think it's important for us to understand that, as they always say, the devil is in the details, and there are no details. And also, how does it affect the people who are taxpayers, first and foremost? How does it affect the people who are them personally out of work or having their homes taken away from them? How does this bailout, $700 billion, directly or indirectly affect them? For many months now, and well over a year, people have been talking about the real estate, situation and the foreclosure rates, and it's an unprecedented rate and affecting people in Los Angeles and all over the country. How will this bailout affect them? That discussion has been going on for over a year, yet at the same time, just over the last 6 weeks or so, there have been discussions about these big bond brokerage firms that are now in trouble, firms that have been around for well over 100 years, and firms that people assumed were going to be around perhaps for another 100 years, and most of them aren't even around today. Let me correct myself. I'm talking about the Treasurer, the Secretary Paulson, when I talk about the feds and the $700 billion bailout. So with that, we'll begin by calling up the CAO of the City of Los Angeles. Actually, the point person on this matter in the CAO's office.
Not quite. Natalie Brill with the CAO's office. Mm-hmm. As you know, I'm the Chief of Debt Management for the CAO. I want to give you a little bit of history on what's been going on in the market. As you know, last March, there was turmoil in the auction rate security market. And those are basically a market of securities that are sold between, obviously, parties and an issuer to raise capital. And that market was affected by the downgrade of the insurers by the rating agency. From there, we went into the housing crisis, which had been going on for a little while, but then it became evident that these insurance companies had been buying these mortgage-backed securities. And those were not the type of loans that were conducive to packaging and selling off. They were loans that were rising because of interest rates. They were loans that people could not pay. They were loans that people got into without understanding what they were, which is, anecdotally what we've heard. And it was evidence that these insurance companies had invested in these. Because of that, they got downgraded, meaning their portfolios that were able to support the type of insurance they were giving to municipalities could no longer sustain that level. As such, the auction rate market went into disarray. It started to bleed into the variable rate market, which are floating rates, which were also insured and also had letters of credits with banks. The domino effect of the subprime
Now, when you
market,
say insured, I think it's important for the public to understand the insurance you're talking about is not FDIC. It's not the federal insurance.
No.
It's private insurance, that those mechanisms that are there within the private industry.
Correct. These are monoline insurance companies. It means that they insure municipal debt, and they insure it as a security for the bondholders, so that if a municipality were to default, they would be the backup to basically pay off the bonds or the debt service, depending on how the policies are written. What happened was that these insurance companies were downgraded by the rating agencies within weeks of each other, all the major ones, and which there are about 7 of them. About 5 of them were downgraded immediately. In the municipal bond market, the way that these variable rate and auction rate bonds were rated was really the rating of the insurance company. So even, for example, the city's a AA. When the insurance companies got downgraded, we got downgraded with them, which meant that our debt became more expensive.
So our rating was directly tied to the health and the rating of the insurance companies.
Yes, that's the way the system was set up. When an analyst, when let's say a Vanguard or Fidelity or one of the big institutions, or you as an investor came to buy bonds, you would look at our rating. But you would look at my rating, you would look at the insurance rating. So I'm a AA, the insurance companies were AAA, and so therefore my bond was a AAA. What happened was when these insurance companies were downgraded, our debt was downgraded with it, because that's the way the market saw it. The market cared about the insurance company's rating more than they cared about the city's rating, for example. So as that happened, the city of LA began to pay more in interest for our bonds. The way that you solve that problem is that you refund into fixed rate debt, or you get a letter of credit by a bank. Well, at the same time that all this was happening, as you know, there was a credit crunch. Banks were no longer lending, again, because of the mortgage securities, because it was happening in the stock market, because it was happening in the mortgage. It all had a domino effect and started to bleed all over the market.
So you're describing something that was happening about 12 months ago?
A little less than that, maybe about 8 months ago, 6 months ago.
8 months ago.
So, for example, the city was able to refund its to issue debt, fixed rate, fine, 4.2 uninsured. The market switched over from looking at insurance to looking at our own credit rating, and that was fine. On the wastewater deal that we did at the end of May, we were able to secure a letter of credit and refund our debt out of the high rates into lower rates. Then it came September. We sold MICLA at the end of August. Beginning of September, we had a lot of the large banks. UBS had gotten out of the municipal bond market. Bear Stearns, as you know, was bought out by JP Morgan, also because of their bad investments. And there began to be speculation that Bank of America would buy Lehman Brothers. We knew Lehman Brothers was in trouble. The profit statements had come out, and we knew they weren't doing well. But then what happened was we also heard that Barclays Capital, which is based in Europe, was going to also buy Lehman, but they only wanted the profitable aspects of Lehman, and Lehman rejected that offer. Over the weekend of September 13th and 14th, the Bank of America decided to buy Merrill Lynch instead of Lehman Brothers.
Now, you're talking about a few days ago.
Yes, I'm talking about less than 2 weeks ago. This left Lehman Brothers without a buyer, and it forced them into Chapter 11 bankruptcy. So on Monday morning, when we woke up on the 15th, the markets reacted shocked that this was going on over the weekend, and that Lehman Brothers, another very large bank, which had been around for, 150 years, was going into bankruptcy. Again, for a lot of the same reasons that I talked about before. Later in the week, Barclays did announce that they had signed an agreement to buy parts of Lehman Brothers. Also last Monday, AIG, the large insurance company, American International Group, announced that its profits were down and needed to find financing or look for a partner to buy. Immediately, the rating agencies downgraded AIG, which increased AIG's need to raise capital. On Monday, the U.S. government said they would not provide any assistance to AIG. Now, you need to understand AIG is one of those companies that has its tentacles everywhere. As an example, they issued guaranteed contracts for investment. So if you're an investor and you want to invest, you can buy stocks and AIG can buy contracts. The city, for example, had an AIG guarantee on one of its reserve funds for its bonds, meaning it was invested there. AIG is also an insurance company.
Now, that city transaction that you just described, roughly what was the amount of that?
There were two, I believe one was for $9 million, one was $6 million, but since then AIG has liquidated those and we have reinvested the money, so we're okay. We did that very quickly.
So we had to move that.
We had to move that. No loss to us. They liquidated and we moved on. AIG also is an insurance company, which means that they are a large holder of several insurance companies. As an example, on our MICLA buildings that we own, they own several companies that insure those buildings against property and casualty insurance. They also have car insurance, home mortgage insurance. So they are really in every market of the insurance company. The third consequence of AIG being in trouble, at least from the city's perspective, and I can only speak to that, is that they are a large holder of municipal debt. The city's portfolio is about $5.5 billion of debt. They own over $1 billion of the city's municipal debt. As such, if they were to start liquidating their assets, they could possibly flood the market with our debt, which would make it harder for us to go into the market.
It would make it harder for us to go into the market on future debt.
In future debt, right.
Okay. That particular debt,
it's already sold.
It's already sold and it's out there.
Right.
Okay.
And I'm assuming that these facts are across the market, across the country. We're a microcosm, but at a macro level, they probably are involved with a lot of different municipalities in these three different areas that I described. So the government decided, instead of saying no, that they would bail out, basically, or give a loan to AIG for $85 billion. Merrill Lynch then went and purchased Bank of America, and Merrill was also facing lower profits and credit problems, and the deal essentially saved Merrill from the same fate as Lehman Brothers.
You're talking about Bank of America buying Merrill Lynch?
Yes, Bank of America buying Merrill. All this leads, I'm just setting the stage for you of what happened last week that basically caused the stock market to be in the position it was in. Basically, the financial markets stopped trading municipal debt. So last week, we had a deal going forward on the convention center to refund the convention center because, as you know, we had AMBAC insurance on that variable rate debt. We had to pull our deal off the market, as did most municipalities. And
now bring us into the time frame where
this is last week, the week of September 15th.
And other municipalities that normally would go out to market and sell their bonds or refinance or what have you, last week, routine activity no longer was routine. No longer.
The market basically shut down. And the reason was no buyers. Because of the turmoil that was going on in the financial sector that I described, on a very macro level, there were no buyers for our debt right now. Not just for our debt, but for debt in general. This included institutions like Vanguard, Fidelity, as well as, other smaller buyers. Everybody wanted to wait and see what the government was going to do.
Now, when you say everybody wanted to wait and see what the government was going to do you have an opinion about that rally last week when it was announced that there was going to be an attempt to look into whether or not there was going to be a massive bailout by the federal government, and I guess the stock market rallied Friday. But what happened yesterday?
Monday, there was a loss again in the stock market. As you said.
So it wasn't up like on Friday?
It came back down again. I think it dropped a little, 300 basis points. The financial advisors probably have a better grasp of that than I do, but they basically dropped back again. And again, as you mentioned, we had 3 pages of legislation with a lot of questions. So I think that moving forward, everybody's basically waiting to see what happens and what is going to be done to stabilize the market. Because as you can see, it's been very piecemeal. This has been going on since the beginning of the year, since January, when you started to see profits going down, and now we're at the end of September.
But what I don't understand is you have sophisticated institutions, you have a sophisticated government, you have signs of what we're seeing in the last couple of weeks, signs of what is to come since the beginning of this year, and yet we only have major headlines in the last couple of weeks. So it appears that the public's attention wasn't the public wasn't brought to this issue to pay attention to it, at least by the mainstream media, up until the last few weeks. People like yourself or some other people who are going to speak in a little while, they heard about it, felt it, saw pieces of it, or what have you, but the general public really wasn't aware of this until the last few weeks.
Correct.
Okay. So this isn't something as old as these major headlines. This is it's a longer time coming than the last few weeks.
Yes. From my opinion, yes. And the city started to feel that effect, like I said, back in February, March, when we realized that it was not only affecting the auction rates, which had all failed because of the insurance companies, but then was starting to bleed into other aspects of our financial life, such as, variable rate debt, the investment side, the letters of credit, the banks being downgraded. It was all, you could see. These are
all entities that we, whether we like it or not, end up doing business with or end up are involved in our business of money.
And because we are a large city, if you include the proprietary departments, we're $13 billion. It's very difficult, not in the second largest city in the country, it's very difficult not to be involved with all these entities because we are large and we have, the city itself, the council-controlled portion of the portfolio is $5.5 billion. But don't forget, you also have DWP, Harbor, Airport, CRA. You have all these other entities that also come to you to issue debt, and there's not enough. It's not enough for us to deal with one or two firms. We have to deal with the entire market to be able to sell our debt and absorb our needs.
Our activities.
Yes.
Now, so what you just described is the city of Los Angeles is affected by this and has been affected by this for months and months past. But there might be smaller cities that maybe haven't gone out to bond anything or refinance a bond in the last 6 months, 8 months, 12 months. So they might not have felt it or had to deal with it or contend with it. Yet the city of Los Angeles has had to move with these changes over the last year or so. Okay.
Correct.
All right.
Although, the banks, it also depends on who you banked with, I guess, and what kind of investments you have. Nobody leaves their money sitting in an account, for a year. We don't know.
Mm-hmm. Now, when you look at, I think what makes it very unique about Los Angeles and a handful of large cities in this country, we tend to be affected much sooner or feel the effects than perhaps smaller cities do because of our level of activity. And like you mentioned earlier, we're probably not going to deal with one bank, we deal with many. We're not going to be dealing with one insurance company, we deal with many. We're not going to be dealing with one entity in a particular industry, but we're going to deal with many. So if some of them have been affected or their life is changing or they're filed bankruptcy or what have you, very likely it's touching the city of Los Angeles because they have some kind of holdings or they have some kind of involvement with the city of Los Angeles already, correct?
Correct. And one of our goals in the financial policies that you have adopted is definitely diversification. We have diversified our portfolio and who we deal with. We deal with a lot of different entities on purpose. So if something happens to one, we at least have something else. What I feel is unique about, what I believe is unique about this market is everybody was touched. We basically were just sitting on the sidelines watching everybody being touched. I mean, we had a variety of insurance companies as an example. Well, when 5 of the 7 large insurance companies are downgraded within weeks of each other,
it's inevitable that we're affected by it.
There's nothing
no way around it.
Our policies were sound. The diversification that you approved, dealing with a lot of different, for example, underwriters, large, small, medium size, we reached across the board. And it still didn't protect us from what happened because it wasn't us. It was the financial markets themselves.
Well, it was deep enough and broad enough in the
Thank you.
financial markets that it was inevitable that we would be
Correct.
affected. Now, when you look at what you talked about, what has happened to date, what do you do? What should the city do to prepare for today and tomorrow? Give me one example of something that perhaps we're already doing differently that we weren't doing 2-3 years ago.
Well, I think that with your lead, we have diversified our underwriters, and that has been very good for us because this way we have a variety of opinions, we have a variety of firms. If one can't go into the market, maybe another one can. The same thing with bond counsel and financial advisors. That's why there's so many people sitting in the room. And I think we're re-looking at the way that we're issuing our debt. We're looking at, is it cost effective the way that we're doing it? Are we going to continue using letters of credit and commercial paper? Or is it best just to go out fixed rate and wait it out? That's one thing that we are definitely looking at. We are looking at flexibility. Are there certain parameters that all the issuing agencies can have with your approval to move quickly? That's something we'll have to analyze. On some programs we do, on some we don't. Is that something the council wants in order to be able to move quickly to save the city money and come back and tell you or fix it later in a month? That's basically for right now. I mean, we have no crystal ball, so it's very difficult to move forward without knowing where the market is. I mean, our main concern today is our convention center debt. On a very, very, selfish level on our part, it's what are we going to do with convention center? Are we going to have buyers when we go to the market? How long should we be in the market for to sell our debt? How should we structure the debt to be able to sell it in the best possible way when we have no comparables? We have nothing to compare how we're going to sell debt.
Because there's not enough
nothing
activity or fluidity for us to actually compare it to?
Correct. And that, will there be buyers in the future? Will institutions come back and restock their mutual funds in order for us to sell? Another thing the government did was they stepped in and they insured mutual funds, I believe at $250,000. They actually offered insurance so the mutual fund sector would stay firm, because that's the sector that most of us, the middle class, have our investments in.
Now, that's in a direct effect, not so much on the city itself, but on the individuals that
residents.
make up our city.
Correct.
Okay.
And the government did that, again, to protect these individuals' investment, because people got scared. They started leaving out of mutual funds. Well, that was more disruptive than helpful. So the government stepped in and said, well, we'll insure. I think it was 250. I don't remember.
I think somebody has the
somebody will
specific
be
answer to
able
that question
to talk about that.
in a few minutes.
But this
yeah.
is all anecdotal things we're, like you said, reading in the press or things that we're getting.
Mm-hmm.
So, we know that Congress will take some action. We don't know when. One of the things that I can tell you is that the longer they take, the worse it could become.
But the thing that I'm cautious about is it's one thing to take swift action, but it's another thing to be too hasty and take action that is swift but actually is going to fail, or that in the long run will contribute or postpone the demise or postpone the inevitable. That's one of the concerns that I have, because my main concern is that $700 billion or $1 trillion or whatever, if the federal government decides to go down that road, they've already gone down that road to the tune of several $100 billion already. If they go down that road, we don't get second chances. We don't have another $700 billion, another $1 trillion here, another $1 trillion there to keep trying things and to see if they live or die, or if they work or don't work. So in your answer of what we have been doing or can do or continue to do, one of the things was to diversify our activities, correct? Now I know I'm feeling old when so the basic, simple English way of saying that is not put all your eggs in one basket.
Correct.
Okay.
And we actually did a good job of that. But like I said, because, like you said, it was so deep and so widespread that even that didn't help us. On some deals, it did.
But we're still affected.
It's still affecting us. Wastewater is a great example of that. We did all the right things. We refunded out. We had a letter of credit. We got a good price. And because of the volatility in the market, where we were paying 1.3% for our variable rate debt, we're now paying 5%. And when I call my peers throughout the state, it's the same. They're all paying now 5% for variable rate debt. So we're hoping that as we move forward, that will go back down again.
Okay.
So we brought on your request some financial advisors. If
Yes.
you'd like to hear from them, would you like me to introduce
Yeah,
them?
no, what we're going to do is hear from DWP, the airport, and the harbor, and then we're going to hear from the financial advisors, because each one of our proprietaries and the city has financial advisors, so we'll bring them all up at the same time. So next, I'd like to hear from the Department of Water and Power. Okay. Let's bring DWP, airport, and harbor. You can sit up at the table, and we can probably have a quicker, more fluid discussion. Okay. Department of Water and Power?
Yes. Good morning. Mario Ignacio, Director of Finance and Risk Control at Ladwp.
And Ann Santilli, Department of Water and Power, Assistant CFO and Controller.
Okay. Mario or Ann, can you help people understand what is the size of the Department of Water and Power when it comes to departments like ours around the country? Are we the 10th largest, the 5th largest, the largest? Where do we rank?
We're the largest municipal utility in the United States.
Okay. And not all utilities handle water and power, but ours does.
Ours does, some utilities just do electric, some do just water, some do just sewer, but ours is the largest water and power.
Water and power, not sewer.
Right.
Okay. All right, thank you. You gave us a document?
The presentation is a 4-page PowerPoint presentation, and the first page actually summarizes the effects to the Ladwp of the financial crisis. 3 areas in the department are affected: debt, investments, and the retirement system. For debt, basically, we are experiencing increased debt service costs, and because of our participation in some power agencies like SCAPA and IPA, our purchase power expense are anticipated to increase as well. As Natalie alluded earlier, there is going to be constrained access to capital markets. The department is in the process of preparing for a bond issuance in November for our power system. We plan to issue $550 million of bonds, and there's concern currently whether we could access the market, given that there's been a backup in the market last week. I believe there's about $6 billion of that issuance that needed to be issued in the market, and they've held up.
$6 billion.
Yes.
So every week that goes by, we can anticipate that number will grow.
Yes.
Until some
at
stability
one point in
comes to the
time,
market.
they would have to issue those bonds. So.
Yeah, sooner or later,
Yeah.
yeah. Uh-huh. But basically, that $6 billion figure is an accumulation of the fact that the market isn't stable enough, and those debts are not being, those bonds are not being purchased.
Yeah. I believe that number was the amount of debt issuance that was scheduled last week. Not it doesn't.
Just in California?
No, I believe it's national. I think the financial advisor.
National?
Probably.
Now, on this page, the first page, you have categories of debt, investments, retirement, and so bottom line is we're already being affected by this market, by what we're reading about in the papers.
For DWP, we have, for the longest time, the market crisis started way before the year started, but it didn't become apparent until the beginning of the year when the bond insurers were downgraded. The department was fortunate enough to have high long-term ratings of AA that we didn't need bond insurance on our variable rate debt, with the exception of one variable rate program, which is called the auction rate program. We issued them in October last year, and we had $125 million, and that was affected, and we acted swiftly in February a week after the market for auction rates collapse, we have converted the weekly auction to a yearly auction. So we were able to avoid market risk and failed auctions for that period.
So on that note, you're basically describing in plain English that we've had to make some changes in the way we do business at the Department of Water and Power, and the net result is it's costing us a little bit more money
Yes.
for that activity. Now, every time we have, especially a combination of it costing us more money to handle our debt, more money, potential losses or erosion from our investments, and then also the long-term matter of when it comes to our retirement account for our employees, when you have all of that combination, the net result is it's a higher demand on the ratepayer, correct?
That's correct.
The making up of the difference at the Department of Water and Power is to the ratepayer.
That's
the
correct.
water rate, how much we charge for water, how much we charge for power.
Mm-hmm.
So we're already seeing and feeling that. If this continues in any semblance or any way it has over the last few weeks, then it's inevitable that we're going to have, the department's going to have to look at our water and power rates specifically due to these effects, correct?
Yes, the rate increases that we have received did not include or anticipated this events and
That
this
discussion was
unexpected
happening before the last few weeks.
Right.
Uh-huh.
But over 81% of our debt issued is already at fixed rates. So we would monitor this and see what other opportunities we had to, reduce costs before we would consider any rate action for this.
But the bottom line is,
The bottom line is it has to be absorbed because
Somewhere.
Right.
and the net effect of this, eventually, I'm sure we have some economists in the room who would, I guess, substantiate the fact that when Americans or Angelenos are putting more money into their hard costs, like, buying gas, paying for their electricity and water, et cetera, and energy bills, things of that nature, then they have less money to spend elsewhere in the community.
That makes sense.
Okay. And what is the total revenue for collections of revenue from the Department of for the Department of Water and Power in a given year?
It's about 2.6 billion on the power side and about 700 million on the water side. It's our gross revenues.
So 3.5.
Yeah, 3.3 billion. So 2.6 and 7.7. So about
So
3.3 billion
$3.3
combined.
$3.3 billion. So, but that gets to my point that I was just talking about. That's $3.3 billion a year in the local economy that goes toward the Department of Water and Power for delivering those services.
Yes,
So if that goes up a few $100 million for whatever reason, like this reason, that's a few $100 million less that the community has to spend on other things.
that's right.
Okay. Continue.
Yeah. For investments, we have limited exposure to Lehman, and we have no direct exposure to AIG. We have anticipated, well, we have been concerned about Lehman and Merrill Lynch, and one of the reasons why we did not include them in our underwriting team that we've established recently. As I mentioned, for the longest time, we have not been that much affected by the crisis. We were able to act on auction rate securities that we have by converting it to yearly auction period. The next event that happened in the market was the AIG, the Merrill Lynch, and the Lehman. And we have, as I said, we have minimal exposure with Lehman and AIG. We don't have direct county exposure except for the agencies that we deal business with, such as CAPA. They have 2 investment contracts with AIG, and we are in the process of deciding whether to terminate them. We could terminate them at par and not loss principal, but the risk there is the interest normally in these guaranteed investment contracts that were entered back in 1991 when AIG was a AAA were at 7%. So if you terminate this securities, you would end up replacing them with securities that would earn a lot less. And that would be lost earnings for the department.
Now, when you look at page 2, it says on the power side, this 4.9 billion figure, what does that represent?
That represents the total debt outstanding for the power system.
Okay, and that's like a snapshot of what we have out there in debt, that people are holding our paper and...
Yes, as of September 1.
Okay, and then on the water side, it's just over 2 billion?
That's correct.
So we have approximately $7
$7
billion
billion.
out there right now.
Yes.
And on a given year, the department probably puts out in new bond activity anywhere between 500 million to $1 billion or possibly more in a given year?
That's correct.
Okay. Is there any anticipation in the next 12 months that it's going to, the demand for that kind of activity for the department is going to reduce dramatically, or that demand will remain similar?
As I said, the power system plans to issue about 550 million in November, and water system will be issuing anywhere from 120 to 150 in January.
So I think the answer is it remains similar because we are doing our power reliability program, and then we have all these water capital improvements for water quality necessities.
So the fact of the matter is, what happens in this market affects us whether we like it or not.
Correct.
Because we're not about to create our own little system on the side where we're in our own little world and we're putting out bonds on our own little market. We are subjected to what's going on in the broader market and the broader categories of things.
That's correct.
That's right.
Okay. So we don't control our world to the degree I'm sure we would like to, but the fact of the matter is we're subjected to what goes on when it comes to all of these national decisions and international markets as well.
Yeah.
Okay.
We were mostly, we felt the effect last week when the money market funds took out.
When you say we felt the effect, tell me how we felt it.
Well, if you would look at page 2, the department has about 1.3 billion of variable rate debt outstanding. It's 969 for power and about 360 million for power. Those are, some of them are reset daily and some of them are reset weekly. And because of what happened to the reserve money market fund, where they said it broke the buck. Basically, money market funds they almost always don't lose principal. And for the second time, I believe in history, this happened, and investors...
When was the last time that happened?
I don't know, I think Great Depression. So, so that caused a lot of consternation among investors, and they withdraw money, or they stop borrowing money, and that was one of the reasons why we're earning, we have to pay 10%, anywhere from 8 to 10%, 5 to 10% on our daily resets. Well, given that this is just a week, we had 5 years or even longer of periods of enjoying 1% and 2% on these variable rates, but we don't know how long this will last. And that's why I'm saying, even without the bond insurance, we're uninsured. We didn't escape the vagaries of the market last week.
So we felt the higher expense just last week, for example.
Yes.
Now, when we're looking at I'm looking at page 3 when it comes to the SCAPA debt.
Yes.
That's an additional 634 million, or is that somehow included in the previous figure on page?
No, this is separate. This is off balance sheet, and this is our share of the SCAPA debt that there are several projects in SCAPA, and we joined 3 of them, and this is our share of those debt.
Okay. And what does SCAPA stand for?
SCAPA stands for Southern California Public Power Authority.
Okay. So these are activities that we participate with other municipalities or other authorities, and then we do things together.
Yes.
Okay. And this is our share.
That's correct.
Okay. And then on page 4, we have an IPA debt. Is that in addition to the previous figures as well?
Yes.
Okay. And what does IPA mean?
Intermountain Power Agency.
That's something we own or something like that?
No, we participate in the coal project. We purchase coal from IPA, and they're in Utah.
Okay.
And
so that's another 1.7 billion?
Yes, although 1.384 of that is fixed, and the department has prepaid 1.18 billion of that leaving about 200 million of fixed plus the remaining variable rate. So I would say about 500 would be the net exposure to that agency.
Okay. So all of these different categories of debt have been affected by what's going on in the market?
With the exception of the fixed rate. Mostly what's affected is the variable rate programs, which for DWP, DWP's direct debt, we have 77% of our debt at DWP fixed and about 23% are variable.
Okay. All right. So this this actually tells a story about how big our department is.
Yes.
Based on how much debt we have and how much debt we actually issue on a given year on average. Okay.
That's correct.
Thank you. Thank you very much. Next, we have the airport.
Steve Martin, the Chief Operating Officer of Los Angeles World Airports.
Marla Blevins, head of the Debt and Treasury section.
Okay. Have we been affected yet by what's going on out there in the last months and weeks?
As you know, we issued bonds in July and closed on August 6th. There was an $853 million issue. We were affected during the course of...
Can you put the mic a little closer?
We were affected during the course of preparing for that, in that our senior book running manager on the deal was Bear Stearns originally, and we had to change bankers during the course of preparing for the deal. But the deal went off largely unaffected, except for one factor. We would originally anticipating using bond insurance at the issue, but it turned out that the bond insurers became illiquid right on the week that we were going to do the issue. So we issued the bonds without bond insurance. The net effect of that turned out to be a savings to us because we did not pay for the insurance. We saved about $16 million in insurance premiums. And since the insurance would have had no value given the condition of the insurers, it actually turned out to be a savings for us.
Savings of about how much?
$16 million.
$16 million.
Yeah. We have over 90% of our debt outstanding is in fixed rate, as was discussed earlier, so we have not very much exposure to the variable rate.
So our potential exposure is in our future issuances.
Yes.
When do you anticipate going back out to the market again?
Well, as you know, we have a big capital program for LAX, and our next anticipated issue would be in the second half of next year, in 2009, and then would be in the market regularly thereafter. So we've anticipated about one issue per year for the next 5 years. So we have a bit of breathing time between now and when we would expect to issue, which would be in the second half of next year.
And if the market is in the same condition at the latter part of next year as it is today, forget it.
Yes,
This country isn't going to be able to weather that long storm anyway.
That's right. So we're, other airports can't issue, just as the city is having difficulty issuing in the current period. But if it goes as long as when we need to do our next issue, this country has bigger problems that haven't been corrected.
Now, I got to ask this question, or maybe I should ask it of the financial advisors, but even though all of this is going on, the market is in turmoil, bonds, $6 billion in bonds didn't get sold last week, but the world of money still has to be moved, money still has to be invested. Even the world of investors can't sit on their money forever, because if you have a lot of money and you sit on it, you're actually going backwards, in essence. Isn't that kind of the case? I mean, people don't invest in these bonds just because they have to. I mean, you don't force people to invest in your bonds. They do it because they have their own needs, their own reasons for doing so, because they want to put the money in these particular places because it makes money for them.
Well, I think the measure in the industry is there's outflows and inflows into the marketplace, and I think, recently there's been a lot of outflows and people going to the sidelines waiting for proper price signals about how to price interest rates and other things on bonds, and the chaos of the current circumstance and the unknown risk factors, I think, means people are having trouble making pricing decisions, so they're going to the sidelines and waiting until the fog clears. Hopefully they will return because they need to invest the money ultimately. But I think it's very hard to invest with uncertainty about what's going to happen, measuring risk and other factors. So I yield to others, but it seems to me that it's very difficult to price anything in this market, and so people would rather wait rather than make a mistake on a long-term investment.
Yeah. Either that or there's a flight to quality where people would invest in U.S. Treasuries because that's the safest security around in the meantime.
We hope it's the safest. It used to be for a long time. Thank you.
Carl Pan, Chief Financial Officer for the Harbor Department.
And you're a little smaller in activity than these other two proprietaries.
We are a little smaller, correct?
What does our debt look like right now? What magnitude of dollars do we have there? Are we going out to the market anytime soon?
The level of debt at the harbor is about $750 million. The debt was, the last issue we had was back in 2006. So we have not been to the market for a while, and we don't contemplate going into the market until, at the earliest, late 2009.
Okay.
All of our debt is fixed rate. We are not in the debt markets either in short term or long term. We haven't issued, as I mentioned, for close to 2 years. A factor of that is there's been a lot of discussion about the kind of capital projects that need to get started at the port. While capital projects are being built, there's some large-scale projects that are still being reviewed, examined, and to be prioritized. And so until that happens and until the harbor and the community kind of come to grips with what should be first, we foresee that we'll probably use our existing cash flow to fund whatever expenses and capital expenditures we may have in the near future until probably late.
So the harbor is, even though it's a big entity and it already has $700 and some million out there on the books, you kind of sort of are able to insulate yourself a little bit by using internal mechanisms and not having to necessarily go out to the market and be subjected to it like other larger entities that we heard of this morning.
That's correct. That's correct. I think traditionally the harbor has managed its finances very conservatively,
But the volume isn't that high.
and the volume is
And
not that high.
the repetitiveness of going out to the market isn't that often.
Certainly, we're not like DWP. We're in the market every year, so it's not the same.
Okay. But sooner or later, you're going to be subjected to this market, whatever it is.
That's absolutely correct. Yes.
All right. Okay. Thank you very much. Appreciate it. Now we have financial advisors. We have financial advisor to the City of Los Angeles. We have financial advisors to the Department of Water and Power, Airport, Harbor. We're hoping that you're able to make your presence this morning. We have more chairs to bring forward. Thank you. Thank you very much. You've heard the dialogue this morning and the nature of the questions. One of the things that I asked at the onset of this meeting is, how long has this been coming about as far as direct decisions and or actions or relaxations or whatever terminology you might use that has perhaps contributed to what we're seeing today in the volatility in the market and the potential for meltdown or actual meltdown with large firms. And correct me if I'm wrong, maybe you have better language in describing it, but I'm a novice at this, and this is your daily life, I would imagine. Who wants to go first? Let's start on the right. Yeah.
Go ahead and go first. Good morning. My name is Joe Mortensen, and I work for Public Resources Advisory Group. We're financial advisors.
Can you put the mic a little closer?
Sure.
Thank you.
We're one of the general financial advisors to the city. We also are one of the financial advisors on the wastewater system, and then we also serve the Department of Water and Power and the Department of Airports as financial advisors.
Okay.
I think it's fair to say that we began to see, the beginnings of this crisis were about a year ago. It didn't begin with the downgrades of the bond insurers, but that certainly is what we started to see some of the market dislocations begin about then. And as Natalie did a good job of laying it out, so the foundation of this crisis really is the boom in housing that was really fueled by subprime mortgage providers, and then the subsequent packaging of those mortgages into mortgage-backed securities that were sold and owned by the major Wall Street firms and insured by the bond insurers.
But wait a minute. That's been going on for decades. What you just described about people buy homes, the mortgages go to these banks, correct me if I'm wrong, the banks get this bulk of mortgages, call it 1,000 or 10,000 individual mortgages, and they put them in a box or what have you, and they turn around and they sell it to the market, correct, in bulk.
True.
That's been going on for decades.
But mortgage lending...
What's the big deal now? What's the big difference?
Mortgage lending standards were loosened, and that fueled the rise in home prices. So you saw this wave of subprime mortgages that were 100% financing, adjustable rate, that basically bet on housing always going up.
Now, that hasn't been happening for decades.
That has not.
Right?
That has been a more recent...
That's what I'm hoping that you can shed some light on. That change in activity, that change or loosening of the logic, increasing the risks, those kinds of things. That, in essence, the accumulation of all of those kinds of activities has contributed as much to this as anything else, hasn't it?
Yes.
But I can understand Joe and Maria Johnson buying their very first home in 2006 and being excited because somebody approached them and said, you can buy a home with no money down. And they say, really? And then they say, and you can buy a home and your payment is only $1,500 a month, but it's a $500,000 home.
And it's only $1,500 a month for the first.
Exactly. And it's on a 1% interest rate, et cetera, but nobody bothers to explain to that couple, the Johnsons, that your payment's going to go up in another year, and again, and again, and again. And even though you might think that the home is worth $500,000 today, there's no guarantee that it's going to be worth a penny more, or who knows if it's going to be worth a penny less, or dramatically more or less in a year or two or three or four or five. But there are professionals at the street level who are supposed to understand all of that, and that the Johnsons are new to because they've never been owners of property, real estate property. They don't. All they see is a payment. They see a home that they could call their own, and lo and behold, they sign on the dotted line. Now you get to the secondary level. You have banks who are supposed to be sophisticated, who have people who have been doing this for many, many, many years. They have a lot of responsibility. They have signature authority on transactions, and they have signature authority on larger activities for the bank. They're watching this happen. And then all of a sudden it's happening for years and years and years, and they're accumulating billions upon trillions of dollars of these kinds of what I would call precarious loans. But now they've accumulated to the tune of trillions of dollars. That's been going on for about 6 years, this trend. So some of this started 6 years ago.
That's true, but the decline in home values that has led a lot of folks to go into foreclosure or do short sales has been more recent.
But the fact of the matter is, here in Los Angeles, for example, one of the hottest real estate markets, the real estate prices were going up in double digits year after year after year. But if I recall, when I was in the real estate industry, the average normal rate of increase in value was about 4% or so on an average year. Yet we're looking at 1 year, 18%, the next year, 20%, the next year, 20-some%, year after year after year. I could see how after 1 year people might say it's a little bit of an anomaly, the market's going to correct itself, but then again, the market didn't correct itself. And perhaps one of the reasons why the market didn't correct itself is because large institutions, for some reason, didn't seem to want to stop the enjoyment of having all of that activity and all of those investments, and then all of a sudden thinking that they're going to pass it on to somebody else, perhaps?
Well, certainly the chickens have come home to roost. The adjustable rate mortgages at these.
Excuse me, but the reason why I have all of you up here is because you're not Joe and Jane Johnson. You're not ignorant people. And I'm not blaming it on you. I mean, I put some of the responsibility on everybody in society for not saying, excuse me, I'm not going to wait till the New York Times or the LA Times sounds the alarm bell. Maybe we ought to start asking some questions now. Maybe we ought to start asking the real questions about how long can this go on? Is this, forget about it being normal, is this good? Seeing a real estate market that moves at that trend for 5 years straight across the country, and certainly in certain markets like Los Angeles, higher than most, is that good?
It certainly has never seemed to be sustainable, in my opinion.
Correct. It hasn't been sustainable. Now you're touching on a subject is why people pay people like yourself the big bucks. Because you go back and say, what happened in 1930, what happened in 1940s, what happened in the 1950s, what's going on with this country, how does the dollar work, the international markets, all those kinds of things, and then what makes sense? What makes sound value in investments, right? Isn't that part of what you do? Try to understand what makes sound activity? Would you like to say something?
Well, I hate to quote Senator. My name is Dan Wiles. I'm with Philbin Rollap and Associates. We're one of the city's general financial advisors working on solid waste and some of the real estate-based, in fact, transactions. At the risk of ducking the question, the first thing I do is quote Senator Obama and say that may be a bit above some of our pay grades in terms of literally dealing with the mortgage market itself. Mm-hmm. There's no doubt there's a complicity really from the top to the bottom, because that person on the street who's the individual mortgage broker can't write that mortgage.
Correct.
Unless Wall Street can package it and sell it.
Correct.
And while
there are underwriting guidelines acceptable to the market. A bank is not going to underwrite a loan and put it on their books unless they can pass it over their shoulder and package it amongst a bunch of them, and then so that they can throw it over their shoulder, they buy it, they give them dollars, and then they reinvest that money, correct? In mortgage loans, for example.
And while we all knew, the last year we've known it's a problem.
Mm-hmm.
Really, if you look back, you'll remember Chairman Greenspan talking about froth in the market, 2005, 6, something like that, and getting a certain level of excoriation for it. I mean, well, he's alarmist.
Mm-hmm.
Turns out he was correct.
Exactly. Chicken Little, sky's falling. Get out of here. You're no fun anymore. This is all about fun. This is all about just watching things grow. Everybody's having a great time. What you just that you just described, as soon as I saw and heard what happened on Friday on the stock market, I said that's a show. To me, it was just like mortgage brokers throwing a party and saying, "Look at how many loans we can turn in on this Friday because we're still doing 1% loans." It's an act, in my opinion. What happened on Friday on the stock market, in my opinion, in my rudimentary understanding of all these matters, it was an act. It was a way of them saying, hey, everybody, let's show that this idea of the feds coming over and investing billions, possibly $1 trillion, to try to infuse the market, not save it, infuse the market. Let's try to show like that's a great idea. Let's rally. Let's make it look like that's going to be a positive thing. But that didn't last very long because reality hit the following business day on Monday.
Buyer's remorse, so to speak.
Exactly.
Perhaps $700 billion is an awfully big number.
It's a big number to Jane or Joe Johnson, but it's not a big number to the market. Can somebody throw out a figure about how much money is actually moving around on a daily activity? How much money is actually in the hands of these big firms?
Well, I happened to hear this weekend, it was the American Life, on PBS, a good hour or two special on the mortgage crisis, which I'd recommend. It's worth a podcast. They said there were $75 trillion in fixed income internationally, globally.
Okay.
What was that figure?
$75 trillion.
75 trillion.
How many
At least it
seats
used to
did-
be 75 trillion. I don't know what it is
What
this
it's worth
week.
today, everybody's got-
No, but that's the point. Now, when you look at $700 billion, it doesn't look like it's like trying to, move an elephant with a pea shooter, the way I see it.
But it does
You're probably not going to get much movement.
It does look like Wall Street maybe, and I'm not an expert in this is the amateur's opinion, or sort of an educated amateur's opinion, is that Wall Street has looked up and said, well, perhaps 700 billion is a little bit rich for our blood, so to speak, a little bit rich for the United States. And the question being, some of yesterday's decrease, 375 points, which is most of Friday's increase,
There you go.
may be that, gosh, it seemed like a good idea on Friday. Now on Monday, we're actually counting what it will cost and what that will mean in terms of tax increases and other expenses foregone and that type of thing. And maybe another method is in order, and that's what's, I understand that's what's being discussed this morning.
How many members of Congress are financial experts? How many of them actually used to run companies that used to move billions of dollars in a given year, or actually have PhDs in the kinds of stuff that you deal with on a daily basis?
I don't think we're that popular.
My point is, Congress right now as we speak, unless they adjourned, I doubt it. I think that thing's going to go on all day. They start 3 hours earlier than us. But they were making discussions this morning about how to move forward and what kinds of policies to put in place, how much relaxing is or is not going to happen, et cetera. And I would venture to say that 9/10 of the people that are going to be supposedly making these decisions on behalf of the public as elected officials don't have any better than a rudimentary understanding of what they're doing. Has anybody ever heard of, something might catch your ear coming from the world that you're in, a congressman or a U.S. senator that you were watching CNN or C-SPAN or something, and all of a sudden you said, my gosh, that person really knows what they're talking about when it comes to the financial world. Has that ever happened to any of you? It hasn't happened to me. And I know very little.
This is a year where I don't think any of us are particularly enamored with expertise like we used to be.
Expand on that, please.
I'm David Broadsley. I'm with K&N Public Finance, part of the army of financial advisors that serve the city. But a lot of very smart, talented, skilled people were making the decisions that have brought us to where the economy is today. And they weren't stupid, maybe a little greedy, but they weren't stupid, and they certainly were as well informed as one could be in the world of finance and markets. So it's a good time in assessing the world to be particularly humble about expertise. And I will tell you that I'm not so sure that the common, you use your parlance, but the common person with common sense may be rising in my estimation of who you want to be making sense of things, because the experts, including those of us who work in finance day in, day out, have, looking back over the last few years, have all been involved in decisions that with 20/20 hindsight don't look nearly as wise as they did at the time in which they were made.
Yeah, we used to call that decisions at 3 in the morning may not be as good when you look at them at 12 noon.
Yeah, it's part of being human, but it's not one of the nice parts, not one of the better parts of being human.
Now,
No, I was just going to say, one of the things that concerns me, and again, I'm not nearly an expert. My wife takes care of my checkbook, so you know where I am. But the issue is that this appears to me to be almost identical to the HUD scandals several years ago, with the exception that the federal government was being defrauded. This has now moved to private industry, who was creating tools and mechanisms to defraud the general public. And when you talk to people in the real estate business, many of them were doing so well. When you talked about, is this bubble going to pop? They had a view of, it's never going to pop because we're going to sell the foreclosures. And we're going to just keep selling the foreclosures. And then what makes this issue, and it goes hand in hand with the city's lawsuit about the greed of the bonding companies that forced us to get lower-rated bonds so we can go pay insurance to get them elevated back to where they should have been. These people who created the very tool of deception called subprime market were silly enough to invest in the tool. I mean, that's what makes it so bizarre. The people that created the fraud got so enamored with it, they invested in it. And then when it blew up, they all looked at each other and said, you know, that was a fraud, and we invested in it. And then when it's all said and done, many of them walked away like the guy at Countrywide, said, I think I'm going to retire with $160 million. I mean, the whole thing was a conspiracy from the beginning. It's just that anyone that was sitting in those rooms knew that person when they walked out could not pay for that house. It would
Eventually.
be a year, it could be 2 years. Many of them couldn't pay on the first level, not even waiting for the variable. They couldn't pay on the first level. I mean, and so the whole thing was, you know, it's just like the car business. You know, when you sell the car and it bumps off the curb, it's your car. It's no longer the dealer's car. So if the motor blows up 3 blocks away, you need to go get your car fixed. Same thing with those houses. They sold houses to people with tools and instruments that they were more sophisticated than the buyer understood. The buyer saw the glitter of the house, looked at their checkbook and said, if everything breaks well and I get the 300% raise and all the things happen, I can make this. They couldn't make it the day they walked out of the building. And so all they did was continue to perpetuate it. I mean, we saw houses in communities that, you know, people laughed at and said, that's $1 million house. That's not $1 million house. Somebody might pay $1 million for it, but that's not $1 million house. So the whole thing was a fraud from the beginning. And the thing that smart people or corrupt people who created the scenario fell on their own sword because they believe the lie.
Their own lives.
And then invested in it, and the whole thing blew up. And again, when you go back, you know, and I hate to be old, because you go back 15 years or whatever it was, it's no different than what they did to HUD. They were creating scenarios of false statements as to your income, false credit ratings, false, but they were defrauding directly the government. This time they defrauded the public, and now the government comes in to bail them out. And so it's not new.
I don't know if you've seen the tulip paintings at the Norton Simon Museum, but they're from the 1600s with the tulip craze, when Europe was speculating in tulips and they were constantly appreciating, and then finally they reached the point where paying 2,000 guilders for a tulip was not economic. The market collapsed and the Netherlands went into a recession. It's nothing new about bubble economies. I think what may be new right now is how interlinked the global economy became, so that there was no safe haven. You could have your money in a money market fund, and eventually that money market fund had an instrument that was a bank instrument that was guaranteeing and you go through this huge food chain of economic events.
In my prior life, we call it a pyramid scheme.
Yeah.
So.
Gentlemen, you wanted to say something?
I don't know if I have much to add that's all that useful, but to your point earlier, I think part of the problem, given the size of the global economy, I think everyone's discomfort is with the proposed solution is, how do we have any idea that it really solves the problem or even addresses it in any meaningful way? We've watched the deterioration of the financial institutions throughout the country, and not just in the country, but throughout the world, because this mortgage phenomenon was not limited to U.S. investors or institutions in the U.S. participating. It was so lucrative that it became a global bank business. And so what we're seeing are then the ramifications of that. And it also spawned a whole industry of derivative products that were marketed by these institutions, credit default swaps they're called. That is a multi-trillion-dollar part of the business that's not very well understood, even by the firms that have these portfolios of these swaps on their books. They're scrambling to sort that out.
Well, one of the things that is most disturbing about what's going on right now is there's something that I've enjoyed as being someone who lives in this country and someone who believes in the fact that we have capitalism, but with rules. You can go to other countries and say you invest money, and all of a sudden the government says, well, we're not going to honor your deed to that property. We're going to take it away. Or the country that my parents came from. My parents didn't like to deal with banks because they experienced banks being closed in their country. So when they came to this country, they were skeptical about banks, period. But in this country, for a long time, you didn't have to worry about handing your hard-earned money over to institutions because there were rules and expectations, and if they followed those rules and we had good guidelines and we had checks and balances, that things would work out really well. You talk about the world economy and the world markets and world investors, but at the same time, one of the reasons why they invested here was because maybe where they made their money, they didn't believe that the stability and the structure there was good for long-term investments. So they moved their money over to the United States.
There's a really good parallel in our industry, and it's the bond insurers, which Natalie did a great job explaining. But the reality is those bond insurers were supposed to be what are called monoline insurers whose primary business was focusing on municipal credits that are very, very safe and almost never default. Mm-hmm. And because of their pressure to create profit for shareholders, they branched into insuring these mortgage pools, which obviously we now all see the folly in that. But it wasn't common knowledge to us in the industry that was a significant portion of the business.
See, the thing is, you touched on something. If these mortgages were being sold on the street and the volume was getting so high that the banks, the bank doesn't hold on to these notes, right? Most banks will sell most of these notes so they can replenish their ability to do more loans, correct? Okay, so, but if the market starts slowing down behind them and they're not selling that fast back there, in other words, infusions of money are coming from new and different places, if that doesn't happen, that would have probably slowed down the market eventually, correct?
Sure.
Because as long as there was more money to throw into the street level of these mortgages, then that encouraged it to continue. But if it were to slow down on the back end, then perhaps they would have started tightening up their measures. They would have started saying, well, since we don't have that much money to lend, why should we give loans to just anybody? Like Councilman Bernard Park said, people who are, if you have a pulse and, you put a mirror in front of your nose and they see that you're breathing, you can get a loan.
Yeah, really restraint anywhere in that process would have served to...
So it just started growing on the top end, the back end, the front end, and it just continued to flow. One of the things that I was told last week, and I'm not sure I understood it, but apparently that these big firms like the Goldman Sachs and the Merrill Lynch and these big firms, they had a cap of an investment ratio, like 15-1 or something like that, some time ago, and that got changed or relaxed, or that cap was now raised to as much as 45-1. Anybody know what I'm talking about?
Their leverage ratio.
Can you please explain what that's called? Can you move the mic over?
Again, moving outside the realm of my direct expertise, but the major Wall Street firms were all very highly levered in recent years, meaning that they were borrowing a lot of money to make it.
Yeah, but wait a minute. They just can't borrow because they feel like it. They have, like I was talking about a few minutes ago, there are parameters in this country. You have limits as to how far you can go when it comes to being within the rules, correct? Aren't you describing a rule? Is it SEC or who puts those restraints or those caps on them?
I think in the investment banking world, it may be market, it may not be regulatory.
Right.
And I think that's, what might happen with Goldman and Morgan Stanley becoming commercial bank holding companies is they voluntarily are entering back into the world of regulation exchange for for other benefits that come from being within the, but I think part of the issue was a lot of these activities were outside of the regulatory schema, so I'm not sure there were limits on capitalization from regulation.
Okay, for example, banks. Banks have limits on capitalization, don't they? For example, like they can only certain kinds of deposits or money that they get their hands on, they can only turn around and invest on a 5-to-1 ratio or something like that, or a 10-to-1.
But they are subject to the control of the currency and Federal Reserve and all that stuff.
And they can only extend credit to the extent they have capital to back it up.
Correct. But it's still on a ratio. It never was dollar for dollar. You get $1 on the front door, you can turn around and work the money on a 1-to-1 ratio. It was always a multiplier effect. Mm-hmm. Now, that being the case, if in fact the person who was talking to me last week, if these big firms had a ratio of 15-to-1, and all of a sudden they can go as high as 45-to-1, in other words, they get $1 on the front end, they can go ahead and spread it thin up to 45 times. In good times, people don't see that to be a problem, correct? Because nothing's coming home as far as bad news. It's all good stuff, meaning if you get $1 and you invest it on the other end and you have, say, a 5% rate of return, that means that on that $1 on the front end, you were allowed to multiply that by 5 cents times 45 or 40 or 30. So that's a pretty good business to be in if all you have to do is collect $1 on the front end or $1 million on the front end, and you can invest up to $45 million on the back end. So that creates an incredible incentive to have a lot of activity, multiply the activity during good times. But on the converse of that, if you're spread that thin and all of a sudden you start losing 5 cents on every dollar on the back end, but you really only have $1 on the front end, that dollar has now just disappeared. Now you're, again, by my way of looking at it, you're in no man's land. You're floating out there and you're scrambling, and all of a sudden the bottom's falling out of this scenario because there's not enough dollars to answer to the money that's on paper. Isn't that how ratios work in essence? Basically, it's because you're allowed to use ratios, you're really using the dollar, you're actually using paper now. Yes.
That's right, and it's the leverage of these firms that has not allowed them to really weather the storm of
even though they've weathered storms for 100 and some years. I think Natalie mentioned that Lehman Brothers was around for about 150 years.
Yeah.
Is Lehman Brothers still around?
They're now Barclays.
I mean, technically?
Barclays Capital.
Yeah.
Is the new name.
So that they got to start taking that marquee off the door, and whatever, if Barclays has been around for 300 years or 20 years or whatever it is, then that's the new truth for that particular entity, right? Lehman Brothers is 150 years of bragging rights is no longer bragging rights. Doesn't exist. They've weathered all those storms. What I'm trying to get at is, are we in a different day today when it comes to regulations and allowable activity by these kinds of firms that perhaps didn't exist 20 years ago and 30 years ago and 50 years ago? Wasn't there a whole litany of regulations and things of that nature that came out that put more restrictions on the market after the Depression?
Yes. There was the Glass-Steagall Act, which really created Morgan Stanley. When Morgan Stanley was divided from Morgan Trust, the bank, when banks and investment banks had to be separate. That was a major portion of the reforms after the Depression. And the Glass-Steagall Act had disappeared. Now, in effect, it's been recreated by the market.
What do you mean
the
disappeared?
Investment banks have been destroyed.
What do you mean disappeared? You might be going a little too fast for it.
Oh, I'm sorry. But the Glass-Steagall Act was it expressly repealed?
It was repealed.
And
when?
And you allowed, was it the 1990s?
89 or so. Late 89.
And you had that wall between commercial banking and investment banking was broken down. And the
it was broken down, stripped away, or obliterated?
The
wall.
It was obliterated. It was erased.
Okay, that wall was erased.
Was erased.
And have we seen a trend in those kinds of walls coming down since the late 80s, early 90s?
The trend has been to deregulate the financial services
Uh-huh.
industry. The trend has been to deregulate the industry, and again, the industry got a certain level of protection. This may be off topic, but remember, bankruptcy laws have been changed that protected the financial services industries as well, that made it more difficult for individuals, John and Jane Doe, to declare bankruptcy and really get out of those debts and get a fresh start. So, we have tended to reward those types of financial activities more and more, I guess, as a society, and we've just created a cycle in which we got more and more, I hate to use the word greed, but more and more desire for income, for higher and higher income, lower perceived risk from that income, and I think a lack of knowledge that history ultimately tends to repeat itself. We heard over and over again, we heard in the late 1990s, we heard that we were the business cycle was over, that growth was a constant, that we would always have growth. And then we had the tech stocks have a bubble, and we learned that that didn't happen. We've had in real estate the idea that growth would be constant. Some of these mortgages, which make no sense from literally on paper, part of the underlying rationale, and lots of us have probably heard it when we looked at new homes. Well, it's okay to buy this on an interest-only basis because the value of the home is going to go up. And in a few years, you'd be able to sell it and make more money than you put into it. We refuse to believe that history could repeat itself, that we could, in fact, have real estate, true decreases in value. And we refuse to believe that leverage could be overdone, like it had been before. We're seeing things that we have seen before. We had just refused to.
There's just more zeros now.
Yeah, we had just refused to believe they could happen.
Okay. Now we're talking.
On that point, what is your perception, or anyone jump in here, as to why the .com era bubble burst?
Wow, you are really outside of my expertise.
But wait a minute.
Okay.
Wasn't part of the .com industry not so much about widgets and things of that nature? It was about paper again. It was about what looked like they had something tangible, but it really was paper.
The first words I was going to use were tulip bulbs. It was what Mr. Broadsley, what David had referred to, that you ended up with an expectation of growth, an expectation of future value that was out of line with the real economic value of the asset.
Sure.
And part of the .com era had, these price earnings ratios got sky high, got really unsustainable absent significant levels of growth. When the significant levels of growth in earnings didn't occur, the prices collapsed.
Yeah, but your average Angelino would say, well, the .com has to do with San Jose up the road a little bit. It has nothing to do with L.A. And then, we read the papers and they use terms like Washington, D.C., and they talk about these big New York firms. The stock market is based in New York, et cetera, all those kind. What does that have to do with Angelinos? What does that have to do with people in Los Angeles? Are we going to be affected by what has been happening or what's going to happen today, tomorrow, and in the near future?
Well, if they have pensions that invested in the .com industry, then they're impacted in the sense that the value of the pension assets would decline based on the amount of the investment in that sector. Same could probably be said for the current situation, to the extent there are investments in financial services industries that are now not worth what they were. There is an impact there.
So whether we like it or not, it'll affect how retirement funds / the retirement of individuals.
Correct.
Okay. Anything else?
Just the pervasive gloom and doom in the market right now. Interest rates are up, credit is tight. Anyone who wants to get a home loan is in a very different situation than they were 2 years ago, 1 year ago. Credit has gotten incredibly tight, on both for corporations, municipalities, but also for individuals, and more expensive.
You talk about
And-
talk about wealth. You talk about people who bought homes for $600,000. They're now worth $400,000. They're paying their mortgages, but they're paying mortgages on an asset that they can't recapture the value on. So not only do they not get the appreciation they thought might help them retire or pay for their kids' education, they actually now are paying $200,000 for air. So it's everywhere. I mean, it's everywhere.
This is Lisa Smith from Gardner and Bacon. It is everywhere, but it's only for people that just recently bought homes. If you bought a house a while ago, your value you're still higher than probably what you first bought it for. So it's really more relative to the last couple of years where we've seen the increase in the real estate market, and you're really going to be impacted.
Mm-hmm. Yeah, but people are talking about 150-year-old firms, household names, just poof, they're gone now. How does that affect Los Angeles? How does that affect the Angelino?
This is Jan Mazik from PFM. Obviously, this infiltrates, I think, everyday conversation, but what I would say is that, there's bad news every day. There's bad news all hours of the day. I do happen to be one of those when I got relocated here, bought a house last year, so I know what it's like to pay for air. But, with enough bad news and all that psychological trauma, which I would, it affects employment, it affects how people spend, it affects people's, on CNBC this morning, they were as I was driving into work, to buy a new car today, you're required to have a credit score of over 700. Well, that means most people can't buy automobiles. I mean, it's just everywhere. It's just infiltrated to every person.
What was interesting, I don't know if it's on the federal level or the state level, but they were considering legislation on the housing industry that would make a requirement that you couldn't have a loan unless the mortgage company felt that the person could pay for the note, which we always thought was consistent and already there. But now they're talking about making a law that says you must assess a person's viability to pay. I mean, that shows you how the regulations and the whole system is deteriorating.
Well, there were always regulations and inherent fiduciary responsibilities when it comes to underwriting, especially when it comes to mortgages, whether you're, especially when you're dealing with the general public. Maybe on commercial, it's a different story. Big boys and big girls can waste their money if they want, but there was always inherent protections when it came to the average Joe or Jane buying their first home, the people who were getting, buying a home where if it was going to be applicable to be sold, for example, to Fannie Mae and Freddie Mac, then it had certain guidelines that it had to meet. But obviously, those guidelines were relaxed. Either that or people broke the law. But getting back to my point about how this market affects the average Angelino, or these activities and these what we're reading about in the press, these companies filing for bankruptcy, the federal government looking at bailing out or expending somehow, some way up to $700 billion of taxpayer money to hopefully set this thing on the right course. The market was talked about quite a bit this morning when it comes to bonds. That's something that the city of Los Angeles does. But the city of Los Angeles doesn't put bonds out there because they feel like it. They do it because it culminates in their ability to adhere to their responsibilities, their day-to-day responsibilities. For example, the Department of Water and Power, they're going to go out, I think they're anticipating at the end of this year in November, putting a bond out on the market. And if they do, then they get to fulfill their infrastructure responsibilities, making sure that things don't collapse, making sure that they can continue to deliver the water and power the way it's supposed to be delivered. But if they don't, then perhaps that infrastructure won't get fixed, and perhaps we will see a breaking down of our infrastructure, and therefore the delivery of service will be affected. That's my interpretation of how the average Angelino would be affected by that. If, in fact, the market doesn't, if the bond market doesn't change between now and November. If the bond market, what's the likelihood of us seeing the bond market on a week-to-week basis where you have $6 billion of bonds that didn't get sold from municipalities that on a normal day, they could sell those bonds.
Yeah, I'll take a crack at that one. Eventually, the market will normalize in the sense that, as you mentioned earlier, there's money that needs to be invested, and it will find its way to the best investments. And certainly, Los Angeles bonds will always be in the upper tier.
Is that a guarantee or is that a speculation? I like the fact that you said that LA will always have upper tier bonds.
I think everything is speculation in this life. So in the longer run, there will be some level of footing. In the shorter run, I think we have been shocked by how long it's taken for stability to return to the market.
What do you mean by that? Again, your average American doesn't have a clue what you mean by that. When you say how long, they might be thinking, wow, this has been going on for 10 years? This has been going on for 10 days? What's long for you?
For me, the fact that the crisis that we started really feeling, say, January, February, has accelerated as late as September into October is shocking. I mean, nobody at this table would have ever predicted that we would be not only in the problems that we were in the spring, but they'd be worse than they were in the spring. So it's hard to have any perspective of distance when the end point of the race keeps moving, and I'm sure that there will be residual impacts of this event probably throughout our lifetimes to some extent. And I don't know what those will be and how you quantify them. But I also think that by the first quarter of next year, by the second quarter of next year, there's got to be the semblance of a healthy bond market. I would have said by next month, 2 weeks ago, and once bitten, twice shy. But I don't think that is going to be a lasting crisis. But it could be a quarter.
In the same paragraph, you just said that in the spring of this year, you personally didn't anticipate that things would be worse today than they were in the spring of this year. Yet at the same time, you just said, well, I hope and expect or anticipate that by the first, second quarter of next year, things will have stabilized, we'll have a healthy bond market. But what I'm trying to get at is, please describe for this committee at least one thing that you would think would have to be triggered or happen or set in place for those happier days to come.
Well, I think last
Thanks,
week.
Jan.
Or are we all just hoping that somebody somewhere, some genius is going to stand up and say, I've got the fix. This is the solution. You're the genius?
No.
Okay.
Definitely not.
You grabbed the microphone when I asked the question, so.
Well, I'm at the end. I think it was my turn.
Your turn.
I think you've got a biased group here because we work with municipalities, 24/7. We're looking at a market last week where $190 billion of assets left the money market funds. And those were assets that left the tax-exempt money market fund. Tax-exempt issuers are municipalities, the city of LA, the state of California, issuers that have, as Doug Montague said, virtually no history of going into default. Why would Jane Doe, Marie Johnson, pull their money out of what, in essence, historically, are the safest assets? It makes absolutely no sense. We're sitting here on the sidelines seeing the Department of Water and Power pay 8% for their daily adjustable financings. It makes absolutely no sense. But when, we talk about these institutional investors who, are investing these assets, in the market, well, the underlying investors with those institutional investors are ma and pa investors. And so what we're seeing is a lot of irrational behavior. And until there's a semblance of comfort, security, you're not going to see those assets redeploy and go into those institutions that can subsequently reinvest. Last week, 1-month treasuries, there actually was a negative yield. If you put your money in treasuries, you put 100 cents, a month from now, you'd get 99.5 cents. That makes absolutely no sense.
But it happened.
It happened, and it's unprecedented. And so for those of us who are advising our municipal clients what to do, you know, we're in an unprecedented environment, and if it's going to be a month, 3 months, 6 months, at the end of the day, I think we have to sit back and advise our clients that there's fundamental value in municipal assets, municipal investments, and that what municipalities are doing are providing fundamental services and a good investment, and we're just going to have to find a way. You know, with the city here, the port's lucky. It doesn't have to raise money for a year. DWAP has about a month, 2 months, so it's got some time to sort of weed things out. But at the end of the day, there's good fundamentals, and we've just got to, you know, at the time that you're going to be raising money, look and put you in the best possible instrument at the time.
I would also add to that if there is any silver lining in all of this gloom and doom, it's that, as Mark mentioned, you know, daily variable rate demand bonds of municipalities, highly rated municipalities, are in the 8 to 9% zone, well above treasuries. And if any municipality has money to invest, they'd be well advised to invest in municipal variable rate securities and at least earn some of the yield that they're paying out on the other side.
I don't know how that works,
But you mentioned something about, did you say rational or irrational?
Irrational.
Irrational. So what seems to be irrational? Give me an example of irrational behavior that you were alluded to.
Well, I think the
to.
fact that, you know, you saw $190 billion come out of our short-term market, and the decision to do that was on-paw investor who doesn't understand the difference between what was a AAA pool of mortgages that's now BB and the money market fund that bought that thinking it was AAA, that's now trading at 50 cents on the dollar, 35 cents on the dollar. And equating that investment with Department of Water and Power, variable rate bonds, and saying, well, that's not a safe investment, and because it's in a pool with these what used to be AAA securitized mortgages, and now it's BB, well, I'm just going to pull my money out and go put it in the mattress or buy treasuries. Folks aren't, they're not looking through to the underlying credits and just leaving markets in mass. That's irrational.
It's irrational if a person takes the time to look at it down to the minutia like you just described. But it's not irrational because what they're seeing in the press is fire, fire, run away from this building. And they see investments in general are on fire. Get my money out before it's valueless or before it loses value.
I think we might say it's irrational, but I think in general, I mean, it is a general overall loss of confidence at every level.
Isn't that one of our strengths in this country? We've always been seen as an investment area, an investment of confidence.
Yeah, and I think
short-term, long-term.
Yeah, eventually. I don't know when eventually is, but there's just a general loss of confidence. And I think the natural reaction when there's a general loss of, I mean, I'm not saying it's smart, I'm not saying it's rational, but when people are at a loss of what is taking place, the natural instinct is, I mean, to take your money and run. I mean, it really takes a lot of discipline not to, I don't know, open your 401k statement and not panic and want to head for the hills. I mean, I just don't know when that level of, when confidence of any level is going to return to the market.
And unfortunately, that confidence is hurting the municipalities, and that's what you are. So you're getting impacted when you really shouldn't be because your underlying credit is still strong. Mm-hmm. So therein lies the problem.
So to summarize some of the aspects of how the city of Los Angeles is or isn't being affected by all of this activity and press and what's going on Capitol Hill and what's going on investment markets in general is we're fortunate that the city of Los Angeles is fortunate that it is still a good financial investment. and that we are on some pretty good financial ground. This city is not the kind of municipality that is worrying about filing bankruptcy. There are a couple little tiny cities in California that I think have filed bankruptcy in the last couple of months or what have you. But the city of Los Angeles is nowhere near that. And also we have proprietary departments that are huge, some of the biggest in the world, that they are seem to be on pretty firm ground as well. So as far as the city as a whole, the municipality of the city of Los Angeles, we are still on pretty firm ground. However, whether we like it or not, the fact that we have to go out to markets and we interact with the rest of the world, we are being affected by it based on when we actually engage in that activity. For example, selling our bonds. In addition to that, the average Angelino, especially the Angelino who bought a home maybe in the last 2-3 years and perhaps should not have signed on the dotted line and agreed to pay that mortgage, and they're unfortunately losing their home, they're being directly affected by this. And they're part of, unfortunately, that mortgage is directly part of what's going on nationally and internationally, because that's part of some package of mortgages that some end-of-the-line investors are saying, I bought $100 million in mortgages, and I've got a default rate of 30%, when the normal default rate is, what, about 2%? On a package of mortgages, right, in this country? If you look at the snapshot of what the default rate on mortgages should be, it's in the single digits for sure. Maybe 2%, maybe 3%, starting to feel a little high. But now people actually have mortgage portfolios or packages of mortgages that are now defaulting in the double digits, 10%, 15%, 20%. So Angelinos are involved in those packages because we have a default rate that is one of the highest in the nation, I understand, when you look at regions.
I don't know.
I think
California, I'm not sure.
California, it's more
California is?
Central Valley and
Okay.
Riverside.
San Bernardino.
San Bernardino, Riverside.
Yeah.
Okay.
In the Central Valley.
So again, so you just corrected me by pointing out that the city of LA, even when it comes to the mortgage foreclosure crisis, although the figures are higher than anticipated or normal, we're still lower when you look at the statewide average.
I think so.
So again, as a city, as a community of a city made up of 4 million people, we're affected, but we still are not in the dire situation that other communities are in. Now, the question that we have to ask ourselves, what are we going to do to make sure that we don't start moving away from our certain category into a more precarious category of, you know, how our city is as a municipality, how our community of Los Angeles is? Who do we look to for those kinds of answers? I'm not saying that that's what you're getting paid for, but do you know who actually helps a community like this or assists a community like this to make sure that we don't fall out of some semblance of stability?
I mean, from a financial perspective, or do you mean?
Both from a financial advisor perspective as to what we should be doing, what we should anticipate doing in the short run and the long run, but at the same time, how do we harness that? How do we protect ourselves as a community?
Well, I think the city financially has sound policies, and they've stayed within those policies, which has really helped them why they're not impacted as greatly. And if you keep staying on that course, you should be okay. You're going to have market fluctuations. That's out of your control. But with what you can control and you stay within those policies, you should be okay and fine. From someone else outside of finance, I'm not equipped to ask that question. I'm not sure if anyone else.
Yeah, that's a really good point. You have balanced budgets, you've had fiscal discipline, so the kinds of things that would exacerbate the impact in a financial perspective, you have not done. So maybe it's a combination of good behavior and avoiding bad behavior, but that's very important. I guess the rest of it is what you guys do for a living, which is try to make the city of Los Angeles a desirable place to live, so people, redouble their commitment to the place, don't move, don't flee, and, and make the long-term investments in the city that will keep it viable, notwithstanding short-term fluctuations in economies.
Now, so I guess the city of Los Angeles has shown a certain amount of restraint and discipline over recent years. Not very exciting, but in these times, sounds like I'm glad we did, right? Mm-hmm. Now, when it comes to the economy in general, if you have a certain percentage of your community that are either losing jobs and or losing their homes, et cetera, what's the difference between the federal government coming in and putting policies into place to help that individual versus the federal government contemplating $700 billion to prop up the financial industry, which tend to be very large institutions? What's the difference there?
Well, I think one of the arguments that's being made is, we have a crisis of confidence right now. We have a flight of capital out of the capital markets and going into treasuries. And when you lose access to capital or the cost to capital rises precipitously, that hinders growth. And at the end of the day, you need growth to be able to create jobs, to create the paycheck that's then going to have somebody pay the mortgage. So on the one hand, and it's a public policy debate that's appropriately going on right now, is the federal government's capital best deployed by going into the financial markets and stabilizing them to create access to capital and bring the cost of capital down so, GE, General Motors, and folks like that can continue to access commercial paper to be able to pay their bills and continue to be, viable entities. That's one side of the public policy debate. The other side is let's, filter the money out, to Jane Doe and Maria Johnson and give it to them so that they can stabilize their paychecks and their checking accounts because their employers are in a precarious situation. So it's a public policy debate that is appropriately going on, and I think the question is, will the markets allow sufficient time for the public policy debate to happen so that we make sure whatever solution is resolved is the appropriate one.
I think the question is whether you, and this may be the difference even between the candidates in a presidential election, whether you solve the problem at this macro, at the market level, where you intervene in the market and you prop up the large firms, or whether you try to solve the problem at the micro level, that is, you've got a whole bunch of mortgages that have gone bad. If the people are able to pay the mortgages, they don't go bad. Can you and will the market allow for the kind of time to craft a solution that does that? That therefore starts from lower and lets it trickle up, so to speak.
Well, those are definitely two different, you're absolutely right. Those are two ends of the spectrum of what kind of intervention should be taking place with the public dollar. Yet at the same time, the thing that really bothers me is if you spend $700 billion or $1 trillion to try to infuse the macro aspect of this, propping up the big institutions so that they can get back on their feet and they can hopefully get some momentum and then get moving again. But you're actually rewarding, in my opinion, bad behavior. And scream at the top of your lungs if you think I'm going down the wrong path. Was there bad behavior going on up there at the macro level of these big firms? Again, as I described earlier, Joe and Jane Johnson signing on the dotted line, getting a 1% mortgage. They've never done that before in their life. They've never taken a financial course, et cetera. They don't understand world markets, local markets, anything like that. Then all of a sudden, they sign on a dotted line, but you got institutions relaxing all of their guidelines and their restraints on who to lend money to or what have you, and then they do it month after month, year after year, year after year. It turns into hundreds of millions of dollars, then it becomes billions of dollars, then it becomes trillions of dollars. They were the ones that were supposed to understand that this is not good. This is not sustainable. This is something that might sound like it's fun, and we're doing record volume in transactions and moving money, but they were the ones that were supposed to understand and sound the alarms on themselves and start sending the message down the chain of command saying, we cannot do these 1% variable loans anymore. We cannot have no documentation loans, meaning you don't even have to document your income. You don't even have to prove a pay stub that you actually have a job. Those are the kinds of activities that were happening, but that was underwriting. That was not lies. That was not, no, the underwriters or the brokers of these loans at the street level were not breaking any rules. They were only following the relaxed rules of these big institutions. So we just forgive them and say, gosh, I guess stuff happens. Let's hand some more money over to you so you can set yourself right, and then let's move on. Let's not talk about the past. Let's not talk about how we got here. Does that make sense? Because that 3-page document that was sent over to Congress saying give us $700 billion to infuse into the market didn't have much underwriting details. Can't have much details in 3 pages on this massive, massive issue. It's so just infusing money into the market and trusting should it be as simple as that? I know what my answer is.
None of us have.
I know what my answer is. I mean, Natalie is the key person in the CAO's office. And even at our micro level in our small corner of the world, Natalie comes before this committee and explains what they're doing, why they're doing it, when they're going to do it, why this makes sense, etc. We get to ask questions. We don't just let Natalie do this without some kind of checks and balances. And Natalie just said a little while ago that actually we've changed a little bit the way we've done things, and there have actually been more involvement from the city council in the last few years than perhaps in the last 20, 30 years on this particular matter of our bonds and what we do with our money and how we put it out to market and when we're going to do it, et cetera, than ever before. And actually it resulted in a much more robust dialogue. It resulted in Natalie actually coming up with some different ideas, et cetera, perhaps trying some things that are, have proven sound and true or what have you, and then we've engaged in that. And then because of it, we're in a better position to deal with this craziness that we're reading about in the papers. Not because we said, Natalie, you know what, you've been on the job for X number of years, everything's been going well, why don't you just stop talking to us and just keep doing your thing? You have more time in the day. More time to just do your thing instead of figuring out how to explain it in plain English to us and to everybody else as to why we do what we do, what we're doing, et cetera. Perhaps going back out and then looking at inviting more people to the table and being scrutinous to them as well to see who should be handling our business, et cetera. That is exactly what has happened in the last few years. And it actually has improved our position. Not the opposite, which a 3-page document screams out to me that says, come on, just let us do what we're going to do. There's no need for oversight. There's no need for checks and balances. And then what I hate the most, what I can't stand, is when people purposefully infuse political rhetoric into checks and balances, like strings attached. I think when people talk about strings attached, most Americans think that's a negative thing. I don't want to have strings attached. But checks and balances, when you look at what this country is founded on, checks and balances, that's one of the reasons I feel that this country for 200 plus years has been pretty good looking in the rest of the world, in the eyes of the rest of the world. It's because we do have checks and balances. And I'm hoping to be educated or at least enlightened a little bit about how not having checks and balances might be a good thing right now because we're in such a dire situation. Or maybe checks and balances are a good thing. Does anybody have an opinion on whether or not in the last maybe 10 to 15 years some of the checks and balances or things have been relaxed a little too much on the markets?
It would be hard not to, with what's going on, not to look back and have serious doubts about the way things went. I mean, you would have to be a fool not to at least be reconsidering the nature of the financial institutions that were in place.
But the last 10 to 15 years has been, in retrospect, when you look at the previous 15 years and the previous 15 years, certainly since the Depression, right, rolling forward to today, we were in an era where it was much more free market driven, much less hands-on by the Congress, much less relaxing of rules by the SEC and other institutions. Were we in that in recent history?
Absolutely. We're in an era of deregulation. We're in an era in which many of the regulations we've had since the New Deal have been relaxed under for better or worse, the political belief that the markets will be more efficient and more effective.
Yeah, but the thing is, you put in that human element, and some of you actually used the word, I think the word was used at least twice from this table in front of me, the word greed. When you relax the rules and you give a lot more latitude to the people who their purpose in life, at least in this activity, is to create more and more money off of money, then greed can in fact overcome good common sense.
Sure, we'll convince ourselves that, the likelihood of bad things is very small. We'll convince ourselves that history won't repeat itself. We will create a market like we had a couple of years ago when you would look at the difference, even in our municipal bond market, the difference between a AAA bond and a BBB bond, and you'd see relatively small differences. The credit spread, as we called it, was very tight. Mm-hmm. And in the last year, the American economy has looked up and said, oh my gosh, there really is risk out there. Things really could go bad. And following on what Mark had said, my sense is that we're on a pendulum swing right now. We're at the far end of the swing where everybody is gone, like the picture of the Scream. Everybody's going, and scared to death of anything that looks like risk.
I would describe the last 2 weeks as that. I think that the screaming has gotten, the volume is high, the expressions are very extreme, but the reactions are very extreme as well. For the government to actually contemplate moving toward $1 trillion of taxpayer money, and to try to correct things is an extreme response, very extreme response. Well, one of the things that Bernard Parks mentioned, and I don't know how accurate the figure is, and I think he said that the person who had been running, the person who had been running the largest independent mortgage company was Countrywide, happened to be based here in California, just up the road, just outside of LA County, and that even though he and his board and his team, his corporation, actually participated as much as anybody else in these loans that turned out to be a bad idea, he was dismissed and got to leave with in excess of $150 million on his way out. Again, I think, maybe he's lamenting because, gosh darn it, there was a point in time where his value to that company was $500 million or whatever. But it's a lot easier to lick your wounds when you have $150 million in your pocket than that person who bought one of these mortgages and is being evicted from their home right here in the San Fernando Valley, and they don't have $150,000 or $15,000 or maybe even $1,500 to lick their wounds with and go start all over or try to figure out what to do tomorrow. And that's one of the reasons why my gut tells me that what they're trying to do on Capitol Hill as we speak right now, by trying to convince Congress that they should give $700 billion of authority and responsibility and power to one government entity headed by one person, to me that doesn't make sense. What's that guy's name again? Paulson? Where did he come from before he started working for the government?
Goldman Sachs.
Where?
Goldman Sachs.
Goldman Sachs.
So he was with Goldman Sachs?
He ran it.
Before he started, he ran it, or he was one of the janitors there? How much responsibility did he have in
He was
Goldman
the
Sachs?
chairman.
What's that?
He was a chairman.
A little closer to the microphone.
He was the chairman.
He was the chairman of Goldman Sachs, and now he works for the government, and now he wants to have a heck of a lot of responsibility and authority with very few strings attached and very few checks and balances on $700 billion of taxpayer money. That's in essence what that 3-page was talking about, right? That 3 pages? And what they're debating in this, I think it's the U.S. Senate this morning. A bunch of U.S. senators were on TV this morning making their opening statements. So that's basically what he wants to be able to do. And he was formerly the chairman of Goldman Sachs. What's the status of Goldman Sachs today? As far as, are they in bankruptcy? Are they being bought by somebody? Are they partnering with somebody? Are they still standing firm and without any?
Yesterday, they just got whatever the go-ahead was to create a bank. Because they want retail deposits. I mean, that's one of the stabilizing effects. So Morgan Stanley, Goldman Sachs, I think yesterday kind of got that status.
I mean, and in return for that, they're subject to new rules
and
regulations in terms of the amount of leverage they can have.
Their whole institution, or just the banking side of the institution?
It's the whole institution.
You
They
sure about
became
that?
a bank holding company, I believe.
Give me an example of a restraint that they'll have tomorrow that they didn't have last week.
Lower leverage ratios.
Explain in plain English what you mean by lower leverage ratios.
They can't borrow so much. Make investments.
Like the 15 to 1 or the 45 to 1 I was talking about?
Yes.
What is it?
They were.
Close.
Yeah.
They were about 30 to 1? So they're basically having to pull back on their spreading themselves thin activity, as I would call it. Okay.
In exchange, they get access to the Fed discount window to have access to liquidity.
Again, in plain English?
Access to cash to help fund their operations.
But
at the
access to
federal-
cash
at the
from
discount-
where? Where is that cash coming from?
At the U.S. Treasury, the federal discount window.
And the federal discount window is money that the federal government prints, or that the federal government gets from Dubai investors, and then through the federal government they push it back out to Goldman Sachs?
That they make available to banks to fund their.
I know, but where does that money come from?
Everywhere they get it.
It's that kind of
Including both of the things
We don't
you just
know.
mentioned, the money they print and the money that they borrow. And the
Okay.
money that they receive from taxation.
Right.
So in other words, at the end of the day, this federal money is accountable to the federal government.
Yes.
If the federal government happens to push this money out into an institution, let's not pick on Goldman Sachs too much, say ABC investment firm, and then ABC investment firm all of a sudden just goes bad. The federal government has to figure out how to make up that money, right? If the buck starts somewhere, it's got to come back. Somebody has to be responsible for those dollars.
But it's not just any investment firm, it's bank holding companies. So the institutions have to be organized as bank holding companies.
Okay.
Subject to the regulation.
I have this question. Wasn't it another firm that's in the same category as Goldman Sachs as far as what they call themselves? Didn't they get a portion of their company got bought by a bank? Isn't that another way of doing what Goldman Sachs is trying to do right now?
I think you may be talking about Morgan Stanley, which sold a portion of itself to Mitsubishi. Is that?
Uh-huh. And didn't Bank of America get involved with a particular institution too?
Well, they acquired Merrill Lynch, right?
They acquired Merrill Lynch.
Okay. But by Bank of America acquiring Merrill Lynch was the same kind of company as Goldman Sachs, correct? Same kind of institution, right, categorically. And then by Bank of America buying Merrill Lynch, didn't by that action in and of itself, now they've combined the dual ability that Goldman Sachs is trying to acquire now, to have that dual ability?
It depends on whether it's the investment bank. The Bank of America has an investment banking arm and a commercial bank. So,
But Bank of America has both of those abilities,
right.
right?
In separate entities held.
They're separate, but the advantage is that deposits prove a stabilizing effect to the overall.
The overall corporate.
Yeah, which is what Merrill Lynch achieved and which is what Morgan Stanley and Goldman Sachs expect to achieve.
At least that's the theory this
That's
week.
the theory this week.
Okay, that's the theory this week. Wasn't it about last year that Bank of America actually bought half of Countrywide or something like that?
That's been a while ago, yeah.
I think they bought the whole thing,
I think it was last year. They bought the whole thing. So they bought Countrywide, which was deep into this mortgage situation. And then now they've taken on Merrill Lynch. And they bought Merrill Lynch, or what did they do? They bought Merrill Lynch.
They acquired it.
They acquired them.
For equity.
So they've now swallowed up Countrywide and Merrill Lynch. And so everybody thinks that's healthy. I mean, I guess the opinion makers and the Wall Street Journal and the federal government, everything's
Well,
cool?
in theory, it's at least a private sector solution to the problem rather than a bailout.
Right.
So, I mean, from that standpoint, you may view, and there's questions about whether B of A is now too large, from a monopolistic standpoint. But it's sort of antitrust, I guess. But it's not. But it isn't a question. At least it was done. It was a private sector solution rather than a bailout. So I think we all.
But it remains to be seen as to whether or not that's going to be a long-term healthy solution.
There's a lot that remains to be seen about what's gone on the last few months, yeah.
But I think if you look at what B of A did, I mean, B of A, basically the largest bank in the United States, acquiring the largest originator of mortgages, and now acquiring the largest brokerage firm. If you believe fundamentally in the mortgage market and in the investment brokerage market, it's a wise decision for them. And if you believe that the discipline that over the years B of A has enjoyed in their underwriting and credit standards, if they bring that discipline to the largest originator of mortgages and the largest retail brokerage, fundamentally, in the long term, that should be a good thing.
Yeah, but they have to overcome a short-term responsibility, which is to absorb the losses, right?
Yeah, but when you look at the market response to B of A's decision, they've picked up considerable market value in the last week.
Yeah, but we saw something happen on Wall Street on Friday, and the opposite thing happened on Monday. So isn't an institution like B of A supposed to be the kind of institution that you consider and look at in a long-term basis, not on a week-by-week snapshot?
If you're a rational investor, yes.
Okay. Anything else you'd like to add to this fun discussion? Okay. Well, thank you very much for your insight and your testimony here today. Is there anybody else here for public comment? I don't have any public comment cards. I don't see any public comment cards from other members of the public. So with that, public comment is now closed. And again, I thank you very much. I'm glad to hear that the city of Los Angeles, as far as all of these markets and all this turmoil that seems to be going on in this country and around the world, we're doing okay. And thank God, because we have decisions on the record and activity on the record that shows that we've restrained ourselves from being sexy and going way out there and doing crazy things, and we have some stable decision making, and many of you are part of that advising body of individuals to the city of Los Angeles. So thank you for helping us stay on track. In addition to that, I think that what this committee has done this morning is shed some light on the fact that we are affected, whether we like it or not, by what happens around the country and around the world when it comes to these markets. And for example, the bond market is the most glaring example, where the city of Los Angeles constantly is interacting with that market, and we don't control it, but we're subjected to it. And we are, in fact, having to make adjustments within our own departments, proprietary, and the city of Los Angeles, to adjust to those changes. And without question, the testimony today tells us that the stability is not there right now, and that many things are in flux. Many solutions or potential solutions have not played out yet, and we might not even have touched on things that might come up as solutions tomorrow that nobody's even talked about. So with that, we may be coming together again to talk about these matters in the coming days or weeks, because I think it's important for the people of Los Angeles to have an opportunity to at least hear some dialogue locally on how this affects them, us, and what we are ready to respond or do about the changing world around us, and how we handle our responsibilities as a city. So thank you all very, very much. And with that, this committee is now adjourned.
Thank you.